Welcome to the Norris Group's 13th annual I Survived Real Estate Gala. The Norris Group would like to thank the following platinum partners: Norada Real Estate Investments, San Diego Creative Investors Association, the Outspoken investor Tony Alvarez, Wilson Investment Properties, Think Realty Magazine, and Realty 411. We'd also like to thank our gold sponsors, Seven Figure Flipping, Inland Valley Association of Realtors, Keller Williams Corona, Keystone CPA Inc., Brisas Escrow, Leivas Tax Wealth Management, In a Day Development, NorCal REIA, NSDREI, Pasadena FIBI, Real Wealth Network, SoCal Cash Flow, Spinnaker Loans, and UDirect IRA.
Kathleen Kramer, Orange County, and some investing background in notes. Welcome to the program, and you are up next if you want to share your screen. I did want to say that, Derek, thank you for covering the Compass. Realty announced this week their version of the iBuying program that they're going to be coming out with. I just had the opportunity with the Data Driven Real Estate podcast to interview David, the CEO of Homevestors brand. And as you all know, they're the We Buy Ugly Houses. I'm calling iBuyers the We Buy Easy Houses brand. Please pay very close attention to what they're doing in your backyard. I think they're in almost every county that's being represented here tonight. They're taking down the easy ones. They're doing a terrible job on the rehabs, and they've already admitted because of the open door SEC forms that they're losing money a lot of the time, and they're doing very little by way of the repairs. And their buy box is shrinking. They're going after newer, low-hanging fruit. So just be aware. They're going to go after the easy ones. Investors going after the ugly stuff. You should be fine. All right, Kathleen, it's all you.
Thank you so much, Aaron. I really appreciate being here. It's an honor to speak at I Survived Real Estate. And hey, Bruce, good to see you. And I'm just grateful I didn't have to go on right after Lenska. Good job, Lenska. It was a very lively presentation, and I thoroughly enjoyed it. So hopefully I don't bore you to tears with my data-driven real estate presentation here, but I am going to share my screen and go from here. And I too have a photo of us at I Survived, which you'll recognize some of these characters. And I'm here tonight to represent OC REIA, which I'm very proud to do. We are the Orange County Real Estate Investors Association, founded by Karin Hall that you see there on the left, and you'll recognize the bloke there in the middle. And yes, we're going on our 7th year. And I Survived Real Estate. I have to ask Karin how many years we have been attending I Survived. I missed the first year. I think I was at home with my daughter who had just been born. And I kind of put my head in the sand when the market crashed in late 2008. And thank God for my little girl, because that was just my focus. And it got me through the last crisis. So hopefully we're better prepared for this one. But Aaron asked me tonight to talk about the pulse in Orange County, which I will do. And my husband and I are note investors. So I'm going to share a little bit of color with you about the note industry, what's going on right now for the ground level investor, if you will, not so much at the hedge fund level, but at the ground level, and some ideas for what to look for and where to look for opportunities. So that's my talk tonight. I wanted to invite you to come to OC REIA now that we're all doing Zoom so eloquently in our pajama bottoms and our fancy tops. I wanted to let you know that we do meet every second Thursday of the month at 5 o'clock Pacific, and it is on Zoom. It is free. Isn't that great? Don't real estate investors love that price? Free? They do. Upcoming topics are a note panel, ADUs, which it's interesting that we're talking about ADUs. And of course, our very own Bruce Norris will be joining us in a couple of months to give us his insights into what to look for the new year. So at our meetings, we generally go a couple of hours. We do a market update, which I have been doing now for 6 years, and Karin hasn't kicked me out yet, so I guess I'll continue. deal profile, and then we have the main speaker. So OC REIA, we have seen a tremendous change since COVID. So if you've been to our club, you know that we had about 50 or 60 people, maybe up to 200 when Bruce was in town. But now we regularly have 200 to 300 people on the line every month. And it's fantastic. We have really seen a growth spurt in our club over this COVID episode. So maybe we learned a little something from having to change gears. And so we're happy for that. So grateful. A little bit about myself. I've been in the industry for 30 years. It says 25, but I don't really want you to figure out how old I am. So I'll say 25. I've closed about $1 billion in transactions. I started as a loan officer. I'm reformed from that category now. No longer do loans. Then I got into apartment broker transactions. So did a lot of those. And then I retired for a couple of years. So now I'm an investor, a broker, a lender. My husband and I are partners in a company that invests in non-performing second notes. Oh my gosh, how crazy are we? So we'll talk a little bit about that at the end. And of course, I love to speak in public and on Zoom meetings now, apparently. And I have a bachelor's degree in economics from UC Santa Barbara. And I can tap a keg if you ever need me to come over. I can help you with that too. So anyways, if you need to reach me, you can try me at my email address or on LinkedIn. I like to live on LinkedIn. I'm not so much of a Facebook or an Instagram gal, but LinkedIn seems to be my speed. There's the legal disclosures. And so tonight, I think Aaron asked us to really talk about taking the pulse of the club. So I want to talk about what are the main concerns of our club members. And I think the number one burning question is, did the government drop enough money on us to help us through recovery? Are tenants going to be able to pay the rent? Are landlords going to be able to pay the mortgages? And are we going to have a huge crash in single family thing, or their wholesalers? So a lot of the concern seems to be around the single family market and the apartment market. So a lot of mom and pop investors in the apartment market locally. Of course, we know that a lot hinges on employment. So I pulled this right off of the EDD website today, as a matter of fact. And if you look at the very bottom down there where the blue arrow goes in, I think I'd draw your attention to the year-over-year change in the total amount of jobs lost in the leisure and hospitality industry in California. And so we're looking at a phenomenal sea change in that segment of the market, employment market. And of course, those people are mostly renters, not all. And in fact, in California, we know that we have 0.2 million people living here, all moved to Texas yet. Okay, so, or Florida, Bruce. Our Orange County workforce is about 1.5 million, a little over that. Out of that workforce, we have a 1.42 million employed, and unemployed is 142,000 as of September. So 9% unemployment. However, on the 15th of October, Disneyland announced that they're laying off 28,000, which is huge. So I think if you're an investor doing wholesale deals or you're looking for distress in Orange County, you probably ought to go to Anaheim because its net of Disneyland is tremendous. So they're one of the major employers in Orange County, and this is going to have a significant effect on rents, ability to collect rents, and also some single family owners in the Orange County marketplace. So that puts the estimate, if you add those 28,000 to our unemployment, that puts our unemployment rate at over 10%, which is obviously going the wrong way. By the way, the EDD also is telling us that the median income, which Bruce will appreciate me including this statistic, I think, is 69,000. So Median numbers can be misleading, however. And if you look at the median home price in Orange County, so there's a lot of numbers on this chart. So I'm going to try to clarify it for you here. So in September of 2019, our median home price in Orange County was $830,000. It's gone all the way up to $915,000 as of this September. So just a year later, you're looking at a significant increase in the median home price. However, in May, it was just $834,000. So what happened? So if you look at the green bars on this chart, these are the luxury closed sales, luxury being defined as 1.25 million and over. And what happened is a lot of people that were working in LA County left LA County and moved to Orange County because it's safer here. And it's a little bit less restrictive as far as the lockdown orders. So when you talk about New York, for instance, and the flight out of the city, and you think about San Francisco and the flight out of the city, we also have a similar situation from LA to Orange County. And so our luxury home number of transactions increased significantly over the last few months. So will this trend continue? That is a burning question. However, it would not surprise me to see that median home price go back down to about $850. Why do I say $850? Because if you look at January on this chart, $850 COVID lockdowns started to occur. And I do acknowledge that we have a lot of demand. In fact, I have some numbers on that, but significant changes in the makeup of our buyers. And so we pulled a lot of the luxury homes out of the marketplace. But I don't think that that's a trend that's going to continue on the long term. I think the people that have decided to move are going to move, and they've moved. How long does that continue? That is up for debate. So that's something to watch in Orange County. Here's a little bit more about our actual figures and our numbers. Listing inventory is at the lowest that it's been in several years, since 2012, actually. And so we did just under 4,000 transactions as far as homes that are listed on the market. And so that is significantly lower. And if you see the demand, those are pending sales. You can see that nice V shape there. It's flattening off a little bit, but that's to be expected. Here's a little bit more data for you data wonks out there. We have just over 4,000 currently active in the marketplace. That's the lowest that it's been since 2012. Days on the market is 40. Which again is the lowest that it's been since 2012. And if you take a look at our expected market time, you can see that from even in the 1.25 to 1.5 million marketplace, we've gone from 118 days to 55 days. And significantly in 1.25 million, we went from 109 days this time last year to 42 days. So crazy what's going on. So here are the inventory changes. 6,400 units last year, 4,100 this year, 35% less. Pending sales, 2,300 last year, 3,100 this year, 36% higher. Closings, 2,500 to 3,100 this year, 23% more closings September over September. And price to list is 98.8. So this is no surprise to anyone who lives in California or understands our market. People are very hot, interest rates being low. Distress in the marketplace, definitely not yet. So we're not seeing it. We may see it coming. We'll see. So certainly not in the MLS, right? The number of foreclosures is nominal. The amount of resales with equity is very, very high. It's really not much to talk about on the distress side. How many sales are off market? So if you're seeing distress in the marketplace, most likely it's not going to hit the MLS, right? So thinking about that, how many off market transactions do we have versus what we had in years past? So the green line is 2020, and you see that we have less off-market transactions than we've had in years. So we'll see. And this is a very important number, I think, to watch, because if there is going to be opportunity in our marketplace, so let's look at affordability. And according to the EDD, our median income is $69,000. But I think that most of us could agree that home buyers these days are counting on a two-income household. So I'm doubling that number for my illustration. Our median price, again, I'm taking $850, even though the number is a little higher right now. 30-year fixed rate interest rate, I'm just rounding it off to 3%. Let's just say you don't have a perfect credit score, and you're not putting 30 or 40% down. So let's say your interest rate's going to be 3, 20% down. You better have a pretty nice truckload of cash to buy a house in Orange County. 80% loan is $680. That's well under the conforming loan limit. Payment would be $2,867. Taxes and insurance adds about another $1,000. You're at about $3,800 PITI, which qualifying income at a 42% debt ratio, if you're debt free, would be about $9,100 a month or $110,000 a year. If you have two income households earning $69,000 apiece, you're going to have room to run. So can our market continue to run higher if interest rates stay low? Yep, it can, as long as those higher income wage earners don't lose their jobs. So that would be my assessment on the Orange County marketplace right now. Now, there are some lower end homes in Anaheim. There are a lot of apartments, especially a lot of apartments that have been owned by mom and pop owners for a long period of time in the Anaheim, Buena Park area. I think North Orange County could be an interesting marketplace for people to watch for NODs on apartments and try to buy the debt and get in on the DL on that, the down low. We've already covered this quite a bit. You like that, Aaron? And just in case you didn't know what DL meant. So when will Orange County correct? Well, let's look at the political risk. Okay, this has been covered already tonight, so I'm not going to go into a lot of detail, but I can tell you that a lot of this will become a little bit clearer after the election next week. Are we going to have a split tax roll? Are we going to limit parent to child transfers of tax basis? Will we have legislated or voter approved rent control? And then also, what is the national tax policy? So I know we brushed on this in the earlier segments, but I want to mention that the Biden tax plan, an important part of the Biden tax plan. So with that, we understand that that could be a significant change for real estate investors. I spoke with Debbie at Exchange Resources, Debbie Bannister. She's been there for 20 years. She's vice president at Exchange Resources. She said, almost without exception, the exchanges that she's doing right now are people moving money out of California. They're selling a California transaction, moving that money out of state. So there's a little bit of anecdotal information for you. Here's some apartment data I think is interesting. It compares this comes from Yardi Matrix. They're a software company and a data conglomerator in the apartment space. So that just shows rent growth and forecasted year over year. You'll see the Inland Empire still has rent growth according to Yardi Matrix. In Orange County, we're seeing a little bit of deterioration in rents with a forecast of that to increase. Job growth is decreasing, as we mentioned, and we have some completions coming on. So we do still have some new inventory coming to the market with occupancy at about 95%. And this is a chart of rent growth in LA, Orange County, and Inland Empire. You could see that according to this chart, we still have a little bit of growth, and this is segmented by A class, B class, and C class. One of the things that is very important, and this is going to be important in Orange County also, is how many of the Fannie Mae, Freddie Mac, FHA insurance plans actually convert back to full payments. So again, watching this in the Orange County marketplace, and it's going to be very important to see if these investors or these buyers, I guess, or borrowers who have mortgages if they actually start paying again. I highly recommend you go to blackknightinc.com and you check out their monthly report that they have on the forbearances. They break it down very nicely by category and then also by dollar amount and volume. So now I have a personal bet on this. I think Fannie and Freddie, FHA and VA, I can't speak for the banks themselves and their portfolio loans, but I think that the government agencies are going to have a refinance program after they stop taking new forbearances due to COVID. And I think they're going to do something very similar to HARP, where they allowed a very low qualifying, very low bar refinance, rate and term, no cash out, rate and term refinance to add these deferred balances back into the main principal balance of the new loan and refinance all these loans out. It just clears the balance sheets. It clears up all the bond issues. It clears up so many issues for Fannie, Freddie, and FHA. And it gives everybody a reassurance that we can all go forward. I'd be very surprised if we didn't see something like that as soon as they declare the emergency over, that is. As we know, more people this cycle have equity in their home. So this chart is talking about how many people have equity, and 80% of homeowners have more than 20% equity. Where is the distress? So if we're seeing distress, where is that? It's primarily, this is from the Mortgage Bankers Association, it's primarily in the retail and in the lodging segments of the commercial backed securities. So I know you're going to cover a lot of this on your commercial segment in a week or so, but the banks are preparing for commercial defaults, and this goes into the note business. So Wells Fargo set aside $6 billion last quarter for loan losses, and that's important. And the credit standards are tightening. And the Mortgage Bankers Association prepares a chart every month, and the mortgage credit availability is tightest it's been since 2012. So this is important to watch, especially for private note lenders. This is good for private note lenders, because if people can't go to the bank to get a loan, what do they have to do? Well, they have to come to us, right, Bruce? They need us again. And so originations on new first mortgages should be an interesting area to watch, especially as these credit quality gets tighter and tighter with the defaults increasing. ATOM did a really interesting chart about predictions of how many foreclosures we're actually going to see. So I'd refer you back to them. Here's a chart that they also prepared, which you could look up online, about how many defaults and how many foreclosures did we actually have from 2005 to 2012. And so you could compare that to the predictions, and then that might give you an idea or an understanding of where you think the market might go in the single family space. So pulling it all together, I do think that there are opportunities in notes in 2021. So where do I think those opportunities are? I think that there is going to be some single family distress, but you're going to have to pick those deals up between the notice of default and the sale date, especially in California with all the new regulation. So if you can subscribe to something like Property Radar or County Records Research, and you can get a hold of those NOD transactions and when they occur, and then track down who owns those notes, I think there'd be a great opportunity for note investors to buy those notes at a discount from people that don't want to have to bother to take those deals through foreclosure process. So this is a good space. And that's the first note deal that my husband and I did about 4 years ago. We did that. We pulled a deal from a private Benny off of County Records Research, and we took it through to foreclosure, and it was a good deal for us. So I think that's going to be more and more prevalent. You're going to see some apartment distress, especially mom and pop buyers who bought maybe at a 3 cap or a 4 cap at the peak of the market. And now they don't have enough reserves, or they just don't have the will to take it through to the end because it's so complicated. The eviction process is a disaster in California. And so, there's a lot of opportunity there. Now, if you're Johnny Warbucks or Daddy Warbucks and you have a lot of money in your pocket, Then I think you could go after hotel and retail repurposing, because I think there's opportunity there too, but those are high dollar ticket investments. So, you know, you're going to have to team up or get into some kind of a structured investment. But there is opportunity repurposing these hotel properties and some retail properties. And the rest, I think you can probably read. We're still buying non-performing notes. My husband's business, they're still looking at pools. There's still a lot of transactions being done. We modify the loans that are in our pools, and then we sell them to other hedge funds. And there's still hedge funds buying those notes from us. And we're pretty much back to the pricing structure that we were before COVID hit. There was a little pause. And of course, we have some foreclosure moratorium still going on in several states. So that slows things down a little bit. But at any rate, if you want to hear more about all that, then join us at OC REIA over the next few months. And we're going to have a note panel. We're going to talk about ADUs. We're going to have Bruce come and visit us. And of course, it's the best price of all. It's free. So please come and join us. And again, I want to thank Aaron and Bruce for having me. And thank you, Karen, for always putting your faith in me and OC REIA and letting me give you the market updates. I really do appreciate that. And that's all I've got. So thank you, Aaron. Thank you, Bruce.
Kathleen, I love that prediction. Just so you know, at Property Radar, I have to follow all the distressed and the NODs, and there's nothing to talk about. They're not happening. And I think the federal government, with a nationwide issue like this, I completely agree. They're going to do something in the back end. And I am further going to predict that I do not see them bringing back the risk premium I would be surprised if they do that at the very end of the year. It sort of penalizes the people that really need it, and it's more money in their pockets. So why charge people more to get a lower interest rate? It just doesn't politically sound like that's going to work for me. I don't know.
Yeah, I think they really stepped in it right there when they tried to push that through. And of course, it depends. I don't want to get in the political weeds. It depends on what the next administration is. Because of course, the reason they were doing that is because they want to recapitalize those agencies and take them back private. But I think the timing really stunk, and you shouldn't go tacking on a 0.5 point fee to every refi in the middle of a pandemic. It would have been much smarter for them to start with an 1/8 and then go with another 1/8 and then phase it in over time, and nobody would have even noticed. But crazy times, and nobody's perfect. They'll get it right the next time, I hope.
Oh,
But so much, Aaron. Thanks, Bruce. And I'll be around for questions later if you guys want.
I definitely, we are a little bit behind, but we know we're probably going to go closer to 9 tonight, everybody. So no stress about the questions. Up next is Christina Suter, representing the Los Angeles area, and why she gets ready. Dad, any thoughts so far about what we've covered? Everybody was really given the task. You have about 20 minutes, and thank you, guys are doing great. It's a lot of information packed in. A lot of these presentations could very easily be an hour or more. So I appreciate the data dump.
I completely agree on the how the foreclosure is going to be a non-issue. They're going to figure it out. Plus, these people have a lot of equity. So even if they were aggressive and went to trustee sale, they wouldn't reach the bank. They wouldn't become an REO very often. But I don't think there's any appetite for that. I really don't.
Okay. All right, Miss Christina, you are up. Thank you for being here. The Pasadena FIBI, longtime supporter, and really glad you're here.
Thank you, Aaron. It's good to be here. Thank you, Bruce. It's good to see you, of course, from Florida. I can't give you a hug, but that's okay. You'll survive, as we all survived real estate, right? So thank you. It's nice to be here. I tried to make it a 15-minute presentation. Try to keep it concise and to the point. So I'm going to actually see what we can do here. And Aaron, you'll keep me on task, I suspect. Yes, very good. All right, let me share my screen. Go here, go here. Slideshow. So I think that a lot of what we're seeing is to me, I wanted to sort of touch on, like, I love I Survived. I love the constant movement that you guys are tracking in real estate. I love investing in real estate. I love what the Norris Group stands for. And I feel really appreciative that you guys include me on this I Survived panel tonight. So thank you for that. But it's really, to me, it's what you guys give to the community as a whole. You guys give a clear voice of integrity. You give support for investors, for all of us investors. As I've teased many times, I didn't get the 2006 memo from Bruce, which I wish I had. So that was my big learning curve of the not following the Norris Group. So that was part of why I'm such an avid supporter, because there's a whole community that you guys are supporting, whether it's those of us who are here on this panel, or all of the people who are listening to this, or all the people who will be logging into this and listening to it as a podcast later. So thank you for all that you do, both for, Make-A-Wish as well as for us as a community. So thank you for putting this together, Aaron, and not letting it slip in this year of COVID. All right, so let's talk a little bit. I'm going to start a little bit bigger and work my way down. That's how my brain works. So you guys are stuck with it. So in June of 2020, there was a lot of concepts and a lot of questions going around, sort of like predictions of, where are we going to be? So, in March, it was the COVID lockdown was declared, and all of a sudden everybody's in upset, and we have all these predictions of how life is going to get horrible or not, right? So the gross domestic product at that point was 5%. The Congressional Budget Office projected that COVID would create a potential loss of 3% of GDP. And if you just do some simple math, you'll see that 3% of GDP is 7.9 trillion of our annual GDP. And I think that number is important because I'm going to reference it back later. The projected highest areas of losses was leisure, services in general, hospitality and retail. And really the loss is directly related to the length of what the shutdown was going to be. And there was a, as Linska said so well, like, is it going to be a W? Is it going to be a V? Is it going to be being a K? Like, what is this length of shutdown going to create for us? And what can we survive? At least in my thinking as an investor, that's where my head is going, is the shape of the shutdown is going to define the actual losses in both unemployment and therefore in real estate. Because what does real estate house? Real estate houses jobs. So I'm focused on unemployment and what does it mean as far as losses, as well as general loss inside of one's savings account, and whether that's a worker over who's a Starbucks, or whether that's somebody who works at Bank of America or somebody who works at Apple. What is it going to be their losses? So the S&P 500 at the time was 3,000 with a high of 3,300 up till that time. And unemployment was projected by UCLA possibly being 13%. And Shadow Statistics was saying, no, we think unemployment's going to be 35%. That was the projections. Hey, Shadow Stats, what do you want, Aaron? Right? So of course I can't hear you, but I'm guessing at what you're talking about. Right. So I'm just laying out a bunch of data on, well, here's what we thought was going to happen, but that isn't really what happened. And I want to kind of walk it through a little bit to get a sense for what we thought was going to happen, what is happening, and maybe just for a moment at the end go, well, what does it mean going forward? Right. So here's what happened to GDP. Here's the reality of what happened inside of GDP. And let me see if I can get this box out of the way because I'm concerned you can't see. So here's the reality of what happened in GDP. So we were in 2019, right? Early 2020, 2%. We were hoping to see, inflation's considered above 2%. We want 2%. That's considered healthy for the environment and the economy. Is it 2% GDP growth? We want to see at least that much. And we were. But now here comes July of 2020, and we have a negative 9% for that quarter. And it's important we understand that that's a quarter, that's not the year. Right? Negative 2.9%, according to the Bureau of Economics. I didn't make this up. I'm just telling you where I pulled it from, right? That's what they put forward. So are we on track for a negative 3% GDP, which would be a loss of 7.9 trillion? We might be. We don't have enough data yet, but we might be. Then the Washington Post, right? We talk about what's going to be most affected, what businesses are going to be most affected, where are we going to lose that loss in GDP? And really we see that there's like event planning, automotive, beauty, retail and shopping, which we're not surprised about, and restaurants, which we're not surprised about. And so we are seeing small business closures. In May, I haven't seen more recent data than May, but if anybody's got it, please send it to me. Right? Then we have actual unemployment to date. Now, I want you to take a look at this unemployment, because if you can see here, I'm trying to move my box out of the way, you can see that, wow, unemployment hit, right? 15%. But then it dropped again, this is nationally, to 7.9%. And I'm not overly surprised by that data. It kind of mirrors the GDP we saw, right? There is this huge movement of loss of GDP, huge movement of loss of jobs, and yet these jobs showed up again somehow. Yet, if you look at Los Angeles, right, the LA County, we see 15% in September and 16% in August. So our unemployment isn't 7.9% in Los Angeles. We have a greater, I didn't put the social economics up here, but we have a greater diversity in Los Angeles County. And we have as many waitresses as we have people who work for, you know, Facebook or Google over in Culver City, right? So that's what we're seeing in Los Angeles. If we look at Fred, we're looking at the S&P. S&P, even though we had this huge loss, here's our 33. But notice the new high was 35,000. So I'm seeing some inconsistencies in the data. I'm looking for an answer. I'm going to suggest an answer, but I'm looking for, like, well, what is really happening? So how is this possible? My answer, federal aid, right? Basically, if we take the number I put out, right, which is if we lose 3% of our GDP annually, not quarter by quarter, but annually, that's 7.9%, 7.9 trillion, just math. I could be wrong in my math, but it's around there. What made the difference? Well, we've handed out about 3.5 trillion in aid of different kinds. Take 7.9, take away 3.5, it makes the gap shorter, smaller. And it makes sense how the timing of the PPP loans and the EIDL, all of these programs that are being put out are making a difference in supporting what we projected was going to be truly hard and difficult, and started to show up that way. But there's a floor underneath it called government support. So what is that showing? How is that showing up? Well, the real estate in reality is that it's actually showing up in that people aren't perceiving themselves as strapped as they would have been, or we would have projected if there wasn't this government support. And an unintended effect. To me, it's an unintended effect. I first noticed this effect when I got phone calls from my daughter's school's moms saying, guess what, we're moving. Guess what, we're moving. I'm like, you're moving in the middle of COVID? Why are you moving in the middle of COVID? Explain to me how you could be moving in the middle of COVID. Nobody's supposed to be doing open houses. Well, if we're going to be locked in the city, we want more square footage. If we're going to be locked in our home, we want a different place to be. I mean, it was like just like a pressure that built up in people that said, we're relocating to a new city for a better lifestyle. And they moved to Temecula, they moved to Solvang, they didn't leave California, but they moved to a different place. And so here's what we're seeing in the actual California housing market, sales and price. So we're seeing there's an increase, right, of existing homes, an increase in existing home sales, right? We're seeing prices have gone up by 17% in California, right? We're seeing that unsold inventory is 2 months, which, as we know, is definitely a seller's market and not a buyer's market. And we're seeing median days on market is 11. So this is basic numbers are saying people are not as economically strapped as we thought. They're not as afraid of buying homes because there's a lot of homes that are being sold, but it's not the buying that's afraid. I think it's the sellers who are more afraid. They don't want people walking through their home with COVID while they're living there. So I've seen more homes on the market that have been rehabbed and are empty than I generally see on the market. I'm seeing the demand is I want to move. I'm uncomfortable as long as I'm in lockdown. So the demand has increased, but the supply has gone down. And we're seeing it in the numbers. Los Angeles housing chart, right? So this is the long chart from Fred. I always like using the long-term chart, but you can see it continued to go up here at the very tail end, 2019, 2020. I find this chart interesting because this is pending sales in Los Angeles. And here's the big drop in May of 2020. And then we're not happy, we're going to move, right? And the push up here showing that people were stalled, but then chose not to be. Days on market in Los Angeles is 43 days on market. There's an increase of 14% in Los Angeles County. And the price to list is 100.6, which means that when that's listed, it's generally, there are more times than not where it's going over the list price. Pasadena, so let's get specific to Pasadena since that's where I'm sitting is Pasadena. So the population of Pasadena is 141,000 people. It's the 41st largest city in California. So we're not that big, truth be told, we're not that small, but we're not that significant, right? 94th largest city in the United States. The median home price is 737,000. And yet the median household income, we would say, is about 80,000. And our industries are really medical. We have a lot of Kaiser here, educational, because we have universities here, professional services. So that's kind of Pasadena. This is info. But I had to steal this from a website because they wouldn't let me download it. So here you've got to cut and paste. So forgive me for that. But hey, I wanted to give you the data. And I liked the way they put this data out. So you're stuck. All right. So really what I want you to take a look at is the difference between the red line and the blue line. Right. And this is basically price to list. And to me, it shows the pressure on the market. Right. So if we're seeing the median list prices, the red line moving right along here, just under 1 million, you can see the median sold price in May, just past May, started bumping up above. That's the price to list ratio went up. It pushed up again here. So we're seeing a lot of intensity and pressure in the Pasadena market. I got, clients telling me they're putting in offers. Now they're saying they're going to multiples of 4 to 5, not 20 to 30. I remember when multiples were 20 to 30, but right now we're seeing 4 to 5, but it's enough. It's enough where we're seeing that the market prices are moving up. So right now, Pasadena inventory has been down has gone down 28% from last year. That's the inventory that's available. 49 median days on market, 15 weeks of increases in pending sales. So you can see the pressure in the Pasadena market has been as intense as it's been in the other markets. So let's get to moving forward. So I should be on time, right, Aaron? I should be moving. Okay. So let's go to moving forward for a minute. So I have this theory, and I'm going to tell you how I'm tracking this. Small businesses employ 49 to 53% of US workers, depending upon where you get the statistic from. 95% of small businesses, the official definition of small businesses is 500 employees or less. 95% of those small businesses that employ about, I'm going to say 50% of our workforce, hire 10 employees or less. So who are those people? Nail salons, barbershops, the dog kennel where I take my dog to get her washed and get her trimmed, right? The restaurants, right? These are the people that are small businesses. The coffee shop that's not a Starbucks. What concerns me is that we saw 100,000 people, 100,000 small businesses have closed since May. That's the May. Oh, there's my timer. 100,000 people have closed, 100,000 businesses have closed since May. We know that those small businesses, which generally don't have larger reserves, are hiring maybe 40 to 45% of our workforce. We're seeing larger employees starting to lay people off. What does this mean moving forward? Because real estate houses jobs, at least for me as somebody who's owned rental real estate and been in residentials of different kinds almost my whole investment career. What does this mean moving forward? I'm thinking, as many of us are, that moving forward, it means that even though we're being held up by this support of the 3.5 trillion, and we're worried there's a potential gap in our GDP of 7.9 trillion, I'm worried that when the support stops, we're going to see a deficit in employers, not in people who want jobs, but people who are capable of hiring, because we've seen the losses in small businesses, and because we've seen the decentralization of larger businesses, and because we've seen even mid-size and larger businesses are laying employees off. When we take the Band-Aid off, that's what I'm concerned about when it comes to employment. Now, my concern is also an opportunity, right? Just as commercial notes is an opportunity and defaults on that is an opportunity, this is going to be an opportunity potentially in the rental markets, whether it's mom and pop rental units, which we've been talking about tonight, or whether it's people who own single families. I can't project. When I tried to project back in June, you saw what my statistics brought up. It didn't work. We had a whole bunch of money that got flooded into the system that completely hijacked my economic point of view. If you want to have, what is it? You want several different points of view, ask an economist their point of view. So I don't know where we're going to go moving forward, but I do know that what I'm tracking to help me monitor what I want to do as an investor is the effect on employment longer term. So FIBI Pasadena is my club. We are also free. We are also monthly, except for December. And you're welcome to come to our meetings via Zoom. We are continuing to do it via Zoom. And it's wonderful to be invited. Thank you, Aaron.
Thank you, Christina. Just for everybody, isurviverealestate.com, and under speakers, you're going to see all the bios. And Joey, just a real quick shout out. I could not have pulled this off. He basically did everything. Joey, thank you from the bottom of my heart. This would not have been possible this year without your help. Joey and I will make sure that all the clubs that we're talking about tonight, that they are linked on the iSurvive Real Estate website. As you know, that has stayed up since 2008. We really appreciate all the speakers that have participated over the years, so we'll make sure to profile everybody.
Thank you for tuning in to iSurvive Real Estate 2020. To watch the full video in its entirety or to learn more about speakers and sponsors, please go to isurviverealestate.com. And be sure to tune in next week for more iSurvive Real Estate 2020. Thank you.